Welcome to this explainer. Okay, if you are a young professional navigating the world of personal finance right now, you probably feel like you are totally drowning in noise. Honestly, everyone has an opinion on what you should be doing with your hard-earned money, and it can be incredibly overwhelming trying to figure out the right path to actually building wealth. Well, today, we're going to act as your personal financial advisor. We are going to objectively cut through all that noise to help you build your ultimate investment blueprint. I mean, does this sound familiar? Your dad tells you to just buy a house because it's quote-unquote the safest asset. Your uncle insists that gold is literally the only thing you can trust in a crisis. Your best friend is telling you to start an SIP because it's so easy. And then, of course, your bank manager is pushing a fixed deposit for guaranteed returns. They are all telling you something completely different. It's no wonder you're stuck wondering who is actually right. Well, we're going to look at the hard data to find out.
Here's exactly what we're going to cover in our consultation today. We'll look at the great investment confusion, the core trade-off between liquidity and safety, the pros and cons of the major assets, a head-to-head comparison, and finally, we'll build your personal decision matrix.
Part 1. The great investment confusion and finding exactly what fits you.
So the honest truth is there is absolutely no single best investment in the entire world. There's only the right set of trade-offs for your specific situation, because what works brilliantly for your friend might be a total disaster for you. Just look at the stark contrast in wealth creation based on historical 20-year long-term averages. Over the last 2 decades, an equity SIP tracking the Nifty 50 has delivered a compound annual growth rate of about 14%. Gold has also performed incredibly well, bringing in around 14.7% over that same time. Meanwhile, fixed deposits trail way behind at around 7.5%. Now, you might be wondering where real estate is. We didn't include it here because those returns are hyperlocal and highly variable, usually anywhere from 6 to 12%. But remember, these are just historical averages. The actual return you get heavily depends on the specific rules of the asset class.
Let's move to part 2, liquidity versus safety, which is really the core trade-off.
This right here is the most foundational concept every young investor absolutely must grasp before handing over a single rupee. Think of liquidity like a glass of water sitting right there on your desk. When you're thirsty, maybe you need cash immediately for an emergency or a sudden opportunity, you can just pick it up and drink. That is instant access. Safety, on the other hand, is like water frozen in a massive glacier. Your capital is highly protected from the elements, it's definitely not going anywhere, but it's going to take significant time and effort to thaw that ice out when you actually need a drink. You cannot have maximum instant access and maximum protection at the exact same time. You always have to trade a bit of one to get the other.
Okay, part 3. Let's dive into the pros and cons of the big 4 assets.
We'll kick things off with systematic investment plans, or SIPs. These have seen an absolute explosion in popularity over the last decade. Contributions in India have jumped from around 43,000 crore rupees to over 3.17 lakh crore. That is a staggering 623% growth. So let's look at why they've become the absolute go-to for young salaried professionals.
SIPs are your ultimate wealth compounders. The pros are incredibly strong here. Historically, they've generated 12 to 15% long-term annualized returns. They're highly liquid, meaning you can get your money out in just 2 to 3 days, and you could start with as little as 500 rupees. If you consistently invest, say, 5,000 rupees a month for 10 years, history shows us that can grow into a massive corpus. But there is a very real con, and that's short-term volatility. Equity markets go up and they go down. In a bad year, your portfolio could literally drop 20 to 30%. And if you panic during those drops and sell, you permanently lock in those losses. So SIPs really require a minimum 7 to 10-year horizon and a whole lot of patience.
Next, let's shift to the favorite of previous generations, real estate. Now, before you even think about the potential returns of buying a property, you have to look at the upfront costs. Buying physical property immediately hits you with a 5 to 7% stamp duty, plus you got registration, brokerage, and maintenance. These costs instantly eat into your returns.
Real estate is the classic tangible asset, right? You can touch it, you can live in it, and it can generate rental income. It also allows for leverage, which means you can use a home loan to control a massive asset. But the cons are pretty hefty. Remember our glacier analogy? Real estate is highly illiquid. Selling a house can take months, sometimes even years. And there's a massive entry barrier. You're often looking at 20 to 30 lakh rupees just for a down payment in a major city. To be completely honest, for most young salaried investors, equity SIPs will actually outperform direct residential real estate in total wealth creation and tax efficiency. Although, if you just want that real estate exposure without the massive hassle, you can always look into REITs, real estate investment trusts, which let you enter the commercial market with just 10,000 rupees.
Now, what about your uncle's favorite, gold? While it has always been a traditional cultural staple and a classic safe haven, it has had an absolute moment recently. In just the first 9 months of 2025, gold prices surged by an astonishing 35%, touching brand new highs of over 1 lakh rupees per 10 grams.
But we really have to view gold objectively here. It is a brilliant crisis hedge. The pros? It's highly liquid, and it acts as a fantastic hedge against inflation and a weakening rupee. The major con, though, is that physical gold generates absolutely zero income. It doesn't pay you rent, and it doesn't pay you dividends. Its value relies purely on price appreciation. A much smarter way to invest in gold is through sovereign gold bonds, or SGBs, which actually give you a 2.5% interest rate on top of the gold's appreciation. Still, gold shouldn't really be your primary wealth builder. It is a diversifier. Finally, let's address the bank's favorite, the fixed deposit. While a bank might boldly advertise a guaranteed 6.5 to 7.5% return, here is the harsh reality. If inflation is running at 5 to 6%, your real return, as in your actual increase in purchasing power, is really only 0.5 to 1.5%.
So fixed deposits are the safe but very slow option. The pros are undeniable if you value absolute safety above all else. Your returns are guaranteed, there is zero market risk, and your principal is insured up to 5 lakh rupees. The con? Inflation is a silent wealth killer. Over the long term, FDs simply fail to aggressively build wealth because inflation is constantly eating away at your real returns. Look, FDs are excellent for 1 to 3 year emergency funds, or the highly conservative portion of your portfolio, but they are simply not designed to make you wealthy over the next 2 decades.
All right, let's move to part 4 and see how this builds into our head-to-head master overview.
Seeing all these assets side by side really puts it into perspective. Look at how equity SIPs offer high 12 to 15% returns and high liquidity for just 500 rupees, but you absolutely must accept high risk. Compare that directly to real estate, which requires 20 to 30 lakhs up front, offers moderate 6 to 12% returns, and has extremely low liquidity. Gold kind of sits in the middle, with strong returns and high liquidity, but low to moderate risk. And then fixed deposits offer very low risk and moderate liquidity, but they cap out at much lower returns, around 6.5 to 8%. You can clearly see that glass of water versus the glacier dynamic playing out right here in the data.
But here is the real expert secret. You actually don't have to pick just one. Investing isn't about finding a single winner. Financial experts often recommend blending these assets to perfectly balance growth, safety, and liquidity. An optimal portfolio mix for a young professional might look something like 50 to 60% in equities through SIPs, 20 to 30% in debt like FDs for safety, 10% in gold as your crisis hedge, and 10% in real estate or REITs for tangible diversification.
Which brings us to our final section, Part 5, the strategy and your personal decision matrix.
The absolutely crucial point here is matching your current life stage to the right asset class. So, depending on your profile, if you're young, you're just starting out, and you have limited capital, your best move is starting an SIP today. If you know for a fact you need money for a wedding or a major purchase in the next 1 to 3 years, put that cash in a fixed deposit for safety. If your primary goal is actually buying a home to live in with your family, then physical real estate makes total sense. And if you already have a healthy portfolio but want to diversify and protect against inflation, put 5 to 10% into sovereign gold bonds. See, there is no one-size-fits-all answer here. There is only the answer that perfectly fits your specific situation.
That brings us to the end of our consultation today, but I want to leave you with a real challenge. I want you to take just 10 minutes right now, sit down, and answer this very specific question. What is your exact 10-year goal, and how much risk can you actually handle to get there? Don't let the daily noise overwhelm you anymore. Use the blueprint we built together today, define your timeline, assess your true risk tolerance, and take immediate financial action. Thanks so much for joining us on this explainer. Stay diversified out there, and we will catch you next time.